Internal audit in banking follows a structured life cycle that ensures independent assurance over governance, risk management, and controls. The life cycle begins with planning, where auditors understand business objectives, regulatory expectations, and prior audit results. Next comes risk assessment, identifying areas with higher inherent and residual risk such as credit, treasury, and information technology. Based on this, scoping defines what will be covered, timelines, and resources. Fieldwork then involves testing controls, reviewing transactions, and interviewing staff to gather evidence. Independence is critical. Auditors must remain objective and free from operational influence, reporting functionally to the board or audit committee. For example, during a review of retail lending, auditors may sample loan files to assess underwriting quality and compliance with policies. The outcome of these stages builds a reliable view of control effectiveness and highlights gaps requiring management attention and timely remediation actions while maintaining documentation standards and clear audit trails throughout. Following fieldwork, auditors move to reporting, where findings are articulated clearly, root cause are analyzed, and risk ratings are assigned. Recommendations should be practical, prioritized, and aligned with regulatory expectations in banking. Effective reports communicate not only what failed, but why it failed and how to fix it, enabling management to act. Governance oversight is reinforced as reports are presented to senior management and the audit committee, preserving independence and transparency. The life cycle concludes with follow-up, where auditors verify that agreed actions are implemented and operating effectively. Consider a case where a bank identified weaknesses in anti-money laundering transaction monitoring. The audit recommended tuning scenarios, enhancing data quality checks, and staff training. During follow-up, evidence such as updated system parameters and training records is reviewed to confirm remediation. This closed-loop approach strengthens control maturity, reduces residual risk, and embeds continuous improvement across the organization over time consistently.